Can AI sustain the stock market rally through 2026? Artificial intelligence has become the single most powerful narrative driving stock markets over the last 2 years. NVIDIA, Microsoft, Google, and Meta, all the so-called AI winners, have added trillions of dollars in market value on the promise that AI will transform industries, boost productivity, and open entirely new revenue streams. So far, though, we haven't really seen tangible returns from those promises, which, as investors, raises an important question. What does AI need to do to deliver for the stock market to keep rallying into 2026? In this video, I'll break down the following: why AI has been the growth engine behind the current bull market, the risks that could derail the AI revolution before it pays off, and what companies need to deliver to justify the lofty valuations that we're seeing today in the market. Hi, I'm Justin Kuntz, Managing Director of Pacific Wealth Management, helping you make good financial decisions through sound management for a secure future. Let's start with why AI has been such a powerful driver for stocks. Since 2022, AI has moved from a buzzword to a real market mover. The launch of ChatGPT and other generative AI platforms opened the world's eyes to what's possible. At the same time, companies like NVIDIA saw record-breaking demand for their AI chips, fueling truly exceptional growth. However, this surge in investment has been largely concentrated in mega-cap tech stocks. In fact, just a handful of companies, including Microsoft, Apple, NVIDIA, Amazon, and Alphabet, have accounted for the majority of the S&P 500 gains. So why does this matter? Well, the stock market is forward-looking, so prices today reflect not just current earnings, but the expectations for future earnings. For AI stocks to keep climbing, at some point, those expectations need to become reality. Now, let's pause and take a look at that reality. A recent study from MIT called the Gen AI Divide, State of AI in Business in 2025. This looked at more than 300 AI deployments, spoke with 150 executives, and surveyed 350 employees. The results were pretty shocking. They found that 95% of organizations reported no measurable P&L impact from their AI pilots. The study points to a learning gap. It's not the quality of the models, rather it's their integration. Generic tools like ChatGPT, while powerful for individuals, often stall in enterprise use because they don't learn from workflows or carry memory in ways companies need for sensitive, high-stakes operations. The second problem is resource allocation. Over half of generative AI budgets are being poured into sales and marketing. But MIT found that the real ROI is in back office, things like automating documents, cutting expense outsourcing. That's where AI can save billions. Even Wall Street took notice. After the study made headlines, AI stocks like NVIDIA and Palantir slipped, as analysts warned that unless companies can prove AI is moving the needle financially, current valuations might be sitting on shaky ground. And it's not just researchers raising red flags. OpenAI's CEO, Sam Altman, is also warning investors to be cautious. When answering your question, he stated that AI is starting to look like a bubble, pointing to the fact that small startups, sometimes just 3 people with an idea, are attracting sky-high valuations. But let's be clear, Altman is in no way bearish on AI. In fact, he believes its long-term potential is enormous, possibly requiring trillions of dollars in new infrastructure, driving massive economic gains. His point is that investors may be getting ahead of themselves. In his words, when bubbles happen, smart people get overexcited about a kernel of truth. So, back to the big question for investors. What does AI actually need to deliver to keep the stock market rally going up? There are 3 key things. The first is sustained revenue growth. Markets aren't going to be satisfied with just 1 or 2 good quarters. Companies like NVIDIA, Microsoft, and cloud providers need to demonstrate that AI demand is not just a spike, but a multi-year trend. For chip makers, that means that orders remain strong beyond the initial wave of data center buildouts. For software, it means AI tools are embedded into products customers are willing to pay more for, whether that's enterprise chatbots, AI copilots, or automated analytics. The second is real productivity gains. The hype around AI is enormous. For stock market growth to continue, investors will want to start seeing evidence in the numbers. That means companies have to start showing improved margins, lowering costs, or boosting sales growth through AI-enabled efficiencies. And now, competition is raising the bar. The recent surge of excitement around DeepSeek and other Chinese AI models have stunned markets with their low-cost, high-performance capabilities. If these companies can continue to build models that are both powerful and cost-efficient, US companies will have a harder time pouring billions of dollars into AI infrastructure and R&D without results. they'll be under greater pressure to justify their massive CapEx spending. The third is broad adoption beyond big tech. Right now, most AI-driven profits sit within mega-cap stocks, but for the rally to be sustainable, adoption has to spread into other industries like healthcare, finance, logistics, and even retail. In 2026, investors will want to prove that AI is horizontal technology, reshaping entire sectors, not just enriching the top 5 tech names. So, what does this all mean for you as an investor? First, you'll want to focus on earnings over headlines. The media loves buzzwords, but in the long run, markets reward cash flow. Think back to the dot-com bubble when adding .com to your name sent your stock soaring, until investors realized that there is no real revenue behind it. The same risks exist today. Just saying AI a bunch of times on earnings calls doesn't prop up your stock forever. That's why it's crucial to dive into quarterly earnings and listen closely to how management is tying AI adoption to actual financial results. Second, don't just watch the big tech names. The real test is when AI-driven improvements will show in places like healthcare, energy, and retail. If we start seeing broader implementation and measurable margin gains outside of Silicon Valley, that's when the story shifts from hype to something that's widespread and sustainable. And finally, remember balance. Even if you're bullish on AI, loading up on just a handful of tech stocks is a huge risk. A diversified portfolio matters now more than ever. AI may be a growth engine in the future, but without risk management, your financial plan could be thrown off course in a single earnings miss or even a regulatory shift. Back in the late 90s and early 2000s, we experienced a lot of new clients walking through our door at Pacific Wealth Management that had a large proponent of their wealth in .com names. While that was fun for a while, a lot of them lost quite a bit of money before coming to us and seeking help to diversify and spread that risk out amongst their investments. Now let's wrap this up with a few key takeaways. 1. AI has been the biggest driver of recent stock market gains, but those gains are pricing in huge expectations. 2. For the rally to last into 2026, companies will have to deliver sustained revenue growth, measurable productivity gains, and broader adoption beyond big tech. 3. Investors should balance opportunity with caution, focusing on earnings, real adoption, and portfolio diversification. It's crucial to make sure that your portfolio is resilient, even if AI and the AI timeline takes longer than expected. Overall, AI is one of the most transformative technologies of our generation. It has the potential to reshape entire industries or even change the way society operates. But just like every other major technological wave before it, the winners will be defined not by hype, but by execution, adoption, and ultimately profitability. I'm Justin Kuntz, Managing Director of Pacific Wealth Management, and if you're interested in seeing how we help our clients at Pacific Wealth get the most out of life with their money, visit us at www.pacwealth.com. Thanks.